Imagine holding the keys, right? The keys to unlock some really significant tax savings for your C corporation.
Hmm.
Today, we're not just imagining. We're diving deep into the powerful strategies, the kind of overlooked details, maybe, that could dramatically reduce your company's tax bill.
Yeah, and put more cash back into the business. That's the goal.
Exactly. Forget the
Yeah.
dry textbooks.
Yeah.
We're cutting straight to the core of what truly matters for your bottom line.
That's right. And our mission today, it's really all about dissecting these intricacies of C corporation taxation.
Okay.
We're going to focus pretty intensely on how income gets recognized and, crucially, how this whole myriad of deductions and special rules can become like your greatest ally.
Allies in financial planning.
Strategic financial planning, yeah.
Yeah.
We've got a pretty comprehensive stack of material here to guide us.
Yeah.
And our goal is to extract every single valuable nugget of knowledge for you. Make sure you walk away, well-informed and kind of empowered to find those tax savings.
Okay, let's do it. Let's unpack this and get right to it. We're starting our deep dive by defining gross income for C Corp.
Right.
What's in, what's out, and why these distinctions can, well, dramatically impact your wallet.
Yeah, and the fundamental concept, it's actually quite similar for corporations and individuals.
Is it? Okay.
The general rule is income's recognized when it's received. You can kind of think of it as your company's economic inflow.
Makes sense.
But it's the specific nuances for C corporations that truly impact your taxable income.
Oh, okay.
And by extension, your tax liability. And this is where the planning really comes into play.
And this is where it gets really interesting for cash flow planning, I think.
Uh-huh.
Because you might logically think, okay, I only pay taxes when I've earned the income, delivered the service or product.
Right, the accrual idea.
But for C corporations, particularly under tax rules, cash received in advance of when it would be formally recognized under accrual GAAP.
Yeah, generally accepted accounting principles.
That cash is still taxed in the year it's received.
Bingo. That's a critical point. It can absolutely accelerate your tax liability.
Wow. Yeah.
Absolutely. This is a classic area where, book income and tax income diverge.
Right.
Just consider examples like getting a big, non-refundable upfront payment for, say, a multi-year service contract.
Okay.
Or maybe an advance payment of rent or royalties.
Uh-huh.
Under accrual GAAP, you might defer recognizing that income over the service period. That makes sense from an accounting perspective.
Right, match the revenue.
But for tax purposes, if you've got the cash in hand, it's often taxable right then and there.
Oof.
Knowing this allows for much better cash flow forecasting, right? Helps prevent those unexpected tax hits.
Yeah, definitely. It's about proactive management rather than reactive surprises come tax time.
Exactly.
That's a powerful distinction. But then on the flip side, you mentioned these fantastic strategic exclusions from taxable income.
Yes, direct savings here.
And one of the biggest, maybe a bit of a hidden gem for some, is interest income from municipal or state obligations or bonds.
Oh yeah, muni bonds.
This is a genuinely significant tax-free income stream for corporations. It's like earning money that the IRS just doesn't touch.
Precisely. It's basically an incentive, right, from state and local governments to encourage investment in their public projects.
Mm-hmm.
And the federal government allows that tax-free status at the corporate level, just like it does for individuals.
Right.
So for a corporation sitting on significant cash reserves, investing in tax-exempt municipal bonds can be a very, very attractive way to generate revenue without boosting your tax burden.
Makes total sense. And another significant exclusion relates to key person life insurance proceeds.
Right, key person policies.
So if your corporation is the beneficiary of a life insurance policy on a corporate officer, maybe the CEO, a critical researcher,
Critical and vital.
the proceeds from that policy can often be excluded from taxable income.
Yeah, it's a vital tool for business continuity, risk management, offers a potentially tax-free payout during a really critical time, like the unexpected death of a founder or key executive.
But there's a catch, isn't there? Especially for newer policies.
There is an important caveat, particularly for policies issued after August 17, 2006.
Okay.
While the general idea holds these proceeds can be tax-free, there are specific limitations now for what's called company-owned life insurance, or COI contracts.
Ah, COI rules.
Right. Unless certain notice and consent requirements are met for the insured employee beforehand.
Okay, so what's the rule then?
The rule basically says the portion of the proceeds equal to the premiums the company previously paid in, plus certain other non-deductible amounts, That part is indeed tax-free. Your basis, essentially.
Got it. Your cost.
But the balance, anything above that initial cost basis, is generally taxable now. This distinction is absolutely vital for accurately assessing the true tax-free benefits you can expect. It's definitely not a blanket exclusion for the entire payout if the policy is post-2006 and doesn't meet those specific COLI requirements.
So it's not just automatic. You got to check the dates, check the requirements.
You really do.
It's those granular details again, separating effective tax planning from, well, potentially costly assumptions.
Exactly.
And speaking of distinctions, capital gains. For corporations, this looks very different compared to individuals, right?
It's a completely different picture.
Yeah.
For individual taxpayers, you often get those preferential lower capital gains rates, especially long-term.
Right. That's a big planning point for individuals.
But for C corporations, nope, that's not the case at all.
No special breaks.
No special breaks here. Corporate capital gains are taxed at the very same rate as ordinary corporate income.
Wow. Okay. Same rate.
Same rate. There are simply no special lower rates, which means your strategy for realizing capital gains inside a corporate structure, well, it might need to be fundamentally different from how an individual would approach it.
So what's the implication then?
Well, the key insight isn't just no special rates. It kind of incentivizes C-Corp maybe to hold capital assets for longer periods, or perhaps use capital gains more strategically just to absorb existing capital losses.
Offsetting losses.
Right. Rather than maybe short-term profit-taking, which might make more sense for an individual paying lower rates, it forces a different investment mindset within the corporation.
That's a critical point to understand. Okay, moving on from what counts as income. Let's talk about the foundation of your tax calculation. Accounting methods.
Yes, accrual versus cash.
Understanding the difference is absolutely crucial for any C corporation.
For sure. For many individuals and even some, really small businesses, the cash basis is the go-to.
Simple enough.
It's pretty straightforward. Income is recognized when cash changes hands. Expense is recognized when cash is paid out. It kind of mirrors your bank account.
Yeah.
But the accrual basis is different. Income is recognized when it's earned, regardless of when cash comes in. And expenses are recognized when they're incurred, regardless of when they're actually paid. Think of it more like matching revenues with the expenses that generated them.
Right, the matching principle from accounting. And here's the critical point for C Corp. While cash basis is common elsewhere, C corporations generally face a mandate. Right? They have to use the accrual method for tax purposes.
If their average annual gross receipts exceed a certain threshold. For 2023, that was $29 million.
$29 million.
Okay.
Averaged over the prior 3 years.
That's right, the prior 3-year period. This threshold is a really significant marker for many growing businesses.
So if your C Corp is above that $29 million average.
You're pretty much looking at accrual accounting for tax purposes.
Yeah.
And beyond that general rule, there are other specific situations that can trigger or, reinforce the requirement to use accrual.
Like what?
Well, for example, if you're accounting for purchases and sales of inventory, and you actually maintain inventories, you will almost certainly need to use accrual, regardless of your size, unless you fall under a specific small business inventory exception, which links back to that same gross receipts test.
Okay, so inventory is a big trigger. What else?
Tax shelters, they're typically forced into accrual.
Right.
Certain farming corporations also have specific rules, though most farming businesses are usually allowed to use cash basis if they choose.
Okay.
And then any C corporation itself, or maybe a trust with unrelated trade or business income, or even a partnership that has a C corporation as a partner. All of these generally fall under that $29 million gross receipts threshold analysis, often forcing the accrual method.
So the implication for you as a C Corp, especially a larger one, is pretty profound then.
It really is. You'll be recognizing income and expenses based on these accrual rules, which can significantly impact the timing of your tax liability.
Timing is key.
Absolutely. It means you might owe taxes on income before you've even received the cash for it.
Ouch.
Or, conversely, you might deduct expenses before you've actually paid them. This is just a core concept that dictates so much of your financial planning and cash flow management. Makes accurate revenue and expense recognition absolutely vital.
Okay. Now let's transition to what I think is maybe the most exciting part for any C Corp looking to optimize their tax position.
Yeah, the deductions.
The power of deductions. This is your comprehensive tax-saving toolkit, truly where the strategic magic happens. It's all about reducing that taxable income.
And it all starts with that foundational standard. Ordinary and necessary.
Right.
The general rule from the tax code is pretty clear. All ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business are deductible.
Okay, but what exactly does ordinary and necessary mean? In the eyes of the IRS, that's where the rubber meets the road, isn't it?
That is the million-dollar question, yeah.
My understanding is ordinary means the expenses are, like, common or accepted in your particular business or profession.
That's right. It doesn't mean you incur them frequently, just that they are typical for your industry. If others in your field commonly pay this type of expense, it's likely ordinary.
And necessary, does that mean indispensable?
Not indispensable, no. It just means they are appropriate and helpful for your business. They contribute in some way to producing the current year's income.
Okay, so think reasonable salaries.
Reasonable salaries paid to employees, yeah. Office rent,
Mm-hmm.
the cost of office supplies, even travel expenses incurred for legitimate business purposes.
Right.
These are all classic examples of ordinary and necessary expenses that are generally fully deductible. The IRS is basically thinking, if a legitimate business person in your field would spend this, then it's probably deductible.
And what's an example of something that wouldn't be?
Well, something purely personal, obviously. Or a luxury item not directly linked to business operations. Or, as we'll discuss later, things like fines or penalties for violating the law. Those aren't ordinary or necessary for conducting business legally.
Got it. Okay, let's delve into some specifics, because this is where the real opportunities and maybe some pitfalls lie.
Definitely.
First up, executive compensation. This is a big one, right?
Yeah.
Often balancing incentive for your top people with the corporation's ability to deduct those costs.
Huge one. And for publicly held corporations, there's a significant limitation now stemming from recent tax law changes.
The $1 million cap.
Exactly. You cannot deduct compensation expenses over $1,000 paid to certain covered employees.
And who are covered employees?
Typically includes the CEO, the CFO, and the 3 other most highly compensated officers in that year.
Okay.
And what's really crucial here, a key detail, is that once an employee is considered covered for a tax year starting after 2016, they remain a covered employee for all future years.
Wow, forever.
Forever, regardless of their role changes, or even if they're no longer one of the top 5 highest paid.
So no shuffling titles to get around it.
Nope, that loophole is closed. It prevents companies from doing exactly that.
Okay. Now, for privately held companies, especially with shareholder employees, it's a different situation, but still really important.
Different beast, yeah, but equally critical. Corporations are allowed to deduct reasonable compensation paid to these individuals.
Reasonable. There's that word again.
That's the operative term, and it's a major area for IRS scrutiny. Because if the IRS deems a portion of a shareholder's salary unreasonable...
What does that mean? Like too high for the job?
Yeah, maybe excessive for the actual services provided, or maybe way out of line compared to what non-shareholder employees doing similar work earn.
Okay, so if it's unreasonable.
They can reclassify that unreasonable part of the salary, treat it as a non-deductible dividend distribution for the corporation.
Ah, okay. So the corporation loses the deduction on that part.
Correct. And this creates a fascinating tension, a kind of dual effect. It's a common area for tax planning.
How so?
Well, look at it from both sides.
Oh.
For the corporation, a salary is a deductible business expense, though it's subject to payroll taxes.
All right.
A dividend, however, is not deductible for the corporation.
Okay. And for the shareholder?
For the shareholder employee, a salary is taxed as ordinary income, plus they pay their share of Social Security and Medicare taxes. A dividend, on the other hand, is generally taxed at those preferential lower capital gains rates for the shareholder.
Got it. So there's this trade-off.
Exactly. It's a balancing act. High salaries reduce the corporation's taxable income, but increase the shareholder's ordinary income and payroll taxes. Dividends don't reduce corporate taxable income, but can be taxed at lower rates for the shareholder.
So structuring that compensation package,
Yeah.
it's an art form, really, balancing those perspectives.
It really is a classic tax planning tightrope walk.
Indeed. And while we're talking compensation, let's quickly touch on bonus accruals.
Good point. Timing is key here.
For accrual basis taxpayers, bonuses are deductible in the tax year when the liability is established,
Right, when you legally owe it.
provided they are actually paid within 2.5 months of the taxpayer's year end.
Yes, that 2.5-month rule is crucial for year-end planning. So if your year-end is December 31st, you've got until March 15th of the next year to pay out that bonus you accrued in December.
And still deduct it in the prior year, the year you accrue.
Precisely. Gives you some flexibility, but you have to meet that deadline.
Okay. Next up, bad debts. How do those work for C-Corp?
For accrual basis taxpayers, which is most C-Corp we're talking about,
Right.
you must use the specific charge-off method for tax purposes. It's also called the direct write-off method. Meaning you write off bad debts only when they actually become worthless or partially worthless. You identify the specific debt that's gone bad.
Okay, so you can't just estimate a general allowance like you might for GAAP.
No, that's a big difference. The allowance method often used for financial accounting under GAAP, where you estimate bad debts in advance based on history. Not allowed for tax. For tax, it's about actual identified worthlessness of a specific debt.
Got it. And what about cash basis taxpayers? I know it's rarer for C-Corp, but...
Right, but it's a critical distinction if you do happen to qualify for cash basis. Generally, bad debts are not deductible for cash basis taxpayers.
Oh, not?
Because the income was never actually included in their gross income in the first place.
Makes sense. If you never recorded the income.
You can't deduct its loss. You didn't pay tax on it, so you don't get a deduction when you don't collect it.
Is there any exception?
There's one very specific, kind of narrow exception, an uncollectible check that was already deposited and you actually did record it as income.
Okay. So if a check bounces after you recorded the sale and income.
Exactly. That's a rare instance where a cash basis taxpayer can deduct a bad debt, but generally no bad debt deduction for cash basis.
Okay. Let's move on to business interest expense. This seems like a big one, too.
It is. Most interest paid or accrued during the taxable year on debt incurred for business purposes is deductible. That's the starting point.
But there's a but, isn't there? A limitation.
There is, especially for larger businesses. It's under Internal Revenue Code Section 163J.
Okay, 163J, what's the limit?
The deduction for business interest expense is limited to the sum of three things. 1, your business interest income.
Okay.
2, 30% of your adjusted taxable income, or ATI.
30% of ATI. We'll need to define that.
We will. And 3, your floor plan financing interest expense.
Floor plan financing. Okay. So why this limit? What's the goal?
It was primarily designed, especially after the Tax Cuts and Jobs Act, to kind of curb excessive debt financing, maybe level the playing field between debt and equity financing, and also to ensure companies pay at least some tax, even if they have very high interest deductions.
Okay, so that definition, adjusted taxable income, or ATI, what is that exactly for this 163J limit?
Right. ATI is essentially your taxable business income for the year, but calculated without certain items. You specifically exclude all interest income and all interest expense.
Okay, take those out.
And importantly, for tax years before 2022, you also excluded depreciation, amortization, and depletion deductions. For 2022 and beyond, though, depreciation and amortization are no longer added back. They stay out.
So the base for the 30% calculation got smaller starting in 2022.
It did. It made the limitation potentially bite harder for some companies. It was meant to be sort of a proxy for EBITDA in earlier years, but it's definitely tighter now.
Okay, and that third piece, floor plan financing interest.
Yeah, that's typically debt used to acquire motor vehicles held for sale or lease, where the debt is secured by that inventory itself. Think car dealerships.
Right.
It gets special treatment, added back fully into the limit calculation because of the specific nature of that kind of inventory financing. Congress gave it a pass.
Okay, so what happens if your interest expense exceeds this limit? Is that deduction just lost?
No, and this is really valuable. Any disallowed business interest expense can be carried forward indefinitely.
Indefinitely.
Yeah. This is a significant planning opportunity. It allows you to use those disallowed deductions in future, hopefully more profitable years when your ATI might be higher. Gives you flexibility.
That's huge. And I bet that $29 million threshold comes back here too.
You bet it does. Here's that crucial small business exception again. This whole 163J limitation does not apply if the taxpayer's average annual gross receipts are $29 million or less for 2023 numbers for the prior 3 taxable years.
So smaller businesses just don't have to worry about this complex 163J calculation at all.
Correct. It's a huge relief and a really valuable benefit for them. Simplifies their compliance significantly. They can generally just deduct their business interests.
That's great news for smaller C-Corp. A couple of other quick points on interest.
Yeah, just 2 quick ones. First, prepaid interest expense. You have to allocate it to the proper period it relates to.
Can't deduct it all up front.
Nope.
Yeah.
If you pay 3 years of interest in advance, you generally only deduct 1 year's worth in the current year, the next year's in the next year, and so on.
Okay. Matching principle again, kind of?
Sort of. And second, crucially, Interest expense on debt you incur specifically to purchase those tax-free municipal bonds we talked about.
Uh-huh.
That interest is not deductible.
Prevents double dipping.
Exactly.
Yes.
You can't get a deduction for the expense if the income generated by the investment is already tax-free. Makes sense.
Okay. Next deduction.
Yeah.
Charitable contributions. Corporations can be generous, and the IRS gives a deduction for that, but there's a cap, right?
There is. Corporations can deduct contributions made to qualifying charitable organizations, but it's limited to 10% of their taxable income. Encourages corporate philanthropy, but sets a ceiling.
10%.
Yeah.
And how is that taxable income base calculated? Is it just the bottom line?
Not quite. It's important to note how that taxable income is calculated for this specific limit. It's figured before you take the charitable contribution deduction itself,
Okay.
before you take the dividends received deduction, which we'll get to,
Right.
and before any capital loss carry back, not carry forward. So you calculate a sort of preliminary taxable income figure first, then apply the 10% limit to that number.
Got it. And what if you donate more than the 10% limit in a given year?
Good question. Any disallowed amount, the excess contribution, can be carried forward for 5 years.
5 years, okay.
So you don't necessarily lose that deduction, you just have to wait to use it in a future year when you have capacity under the 10% limit. That's a great planning tool if your business has an exceptionally profitable year and wants to donate more than the current year's limit allows.
Yeah, smooths it out. And is there a timing rule, like with bonuses?
Yes. For accrual basis taxpayers, accrued contributions, meaning the board authorized it, but maybe you haven't paid it yet, must be paid within 3.5 months of the taxable year end to be deductible in that year you accrued it.
3.5 months, so April 15th for a calendar year corp.
Exactly. Gives you a little wiggle room after year end to finalize your giving and get the cash out the door.
Okay. Now let's talk about losses, specifically business losses or casualty losses related to your business property if something bad happens.
Right. Generally, any loss sustained during the taxable year that's not compensated for by insurance or something else is deductible. The nature of the loss, ordinary or capital, depends on the type of asset involved, usually.
But for casualty losses, like from a fire or a storm, there's a key distinction in how you calculate the loss, depending on the damage.
Yes, a crucial distinction between property that's partially destroyed versus fully destroyed.
Okay, what's the difference?
If property is only partially destroyed, the amount of the deductible loss is limited. It's the lesser of two things. The decline in the fair market value of the property, so value before minus value after the casualty,
Okay.
or its adjusted basis immediately before the casualty, whichever number is smaller.
Lesser of decline in value or basis. Why the limit?
The IRS wants to ensure you're not deducting more than your actual economic loss or more than your investment, your basis, in the property. Makes sense.
Okay. And if the property is fully destroyed, like completely gone?
Then it's simpler. If it's a total loss, the amount of the loss is simply the adjusted basis of the property right before the casualty.
So you don't even look at the fair market value decline if it's totally destroyed?
Nope. The decline in market value becomes irrelevant if the asset is completely gone.
Yeah.
You deduct your basis, less any insurance, of course. This is a key difference that can significantly change your deductible loss amount.
Okay, an example would probably help nail this down.
Yeah, definitely. Let's use the one from our source material. Bad Luck Inc. has a warehouse building seriously damaged by a storm.
Okay, bad luck, Inc.
The fair market value, FMV, before the storm was $850,000. After the storm, it's only worth $400,000.
First, the decline in value is $450,000.
Right, $850K, $400K. And let's say the adjusted basis of the property, cost minus depreciation, was $600,000.
Okay, base is $600K.
And they received $300,000 in insurance reimbursements.
Got it. $300K insurance.
Okay, scenario one. The property is partially destroyed.
Okay, partial destruction.
We compare the decline in value, $450,000, to the adjusted basis, $600,000. The loss before insurance is the lesser of those two.
So $450,000 is less than $600,000.
Right. So the loss is $450,000. Then you subtract the insurance reimbursement of $300,000.
Leaving Bad Luck Inc. with a deductible loss of $150,000.
Exactly, $150K. The key takeaway. Even though their basis was higher, they can only deduct the actual economic loss if it's partial damage.
Okay, now, scenario two. Same facts, but this time the property was totally destroyed by the storm. Okay, total loss.
In this case, we ignore the decline in value, right?
Correct. We don't look at the $450K decline. The deductible loss amount starts with the adjusted basis of the property.
Which was $600,000.
Right. From that $600,000 basis, we subtract the $300,000 insurance reimbursement.
Which results in a deductible loss of $300,000.
Exactly, $300. So you see, same event, same insurance, but the total destruction lets them deduct their full basis, leading to a much larger $300K deduction compared to the $150K for partial destruction.
Wow. That example really highlights how vital it is to know the basis and understand the specific rules for partial versus total loss. Big difference in the deduction.
Absolutely. Knowing that adjusted basis is crucial for maximizing this deduction when a total loss occurs. It becomes your starting point.
Okay. Another important area, especially for new businesses or those undergoing big changes, organizational and startup costs.
Yes, there are some specific rules here, offering strategic amortization that can save tax dollars right out of the gate.
So how does it work? Can you deduct these costs immediately? You can deduct some immediately. A corporation can elect to deduct up to $5,000 of organizational costs and up to $5,000 of startup costs in the year the business begins.
$5,000 of each, so potentially $10,000 total up front.
Potentially, yes. It's a fantastic immediate benefit for new businesses, helps reduce that initial tax burden.
But there's usually a catch with these things, a phase-out.
There is. Each of those $5,000 initial deduction amounts is reduced, dollar for dollar, by the amount by which the total costs in that category, either organizational or startup, exceed $50,000.
Okay, so if your organizational costs were, say, $52,000.
Then your initial $5,000 deduction for organizational costs would be reduced by $2,000, $50K. So you'd only get a $3,000 immediate deduction.
And if the costs were $55,000 or more.
Your immediate $5,000 deduction for that category would be completely phased out.
Yeah.
Zero immediate deduction.
Got it. So that initial deduction shrinks fast if your costs are high. What happens to the cost not deducted immediately, either because they exceeded the $5K limit or because of the phase-out?
Any excess organizational or startup costs, the amount beyond that initial deduction, are then amortized.
Amortized over how long?
Over 180 months. It's 15 years.
15 years, okay.
And that amortization starts with the month in which the active trade or business begins. So it provides a steady, predictable stream of deductions over a long period.
What kind of costs actually qualify as organizational costs?
Think things directly related to forming the legal entity. So legal fees for drafting the corporate charter, the bylaws, minutes of organizational meetings, accounting fees related to the initial setup of the corporation, and fees paid to the state of incorporation, like the filing fees.
Okay, costs of forming the entity.
Exactly.
And it's equally important to know what's excluded, right?
Right.
What doesn't count.
Absolutely. Cost related to issuing and selling stock, things like commissions to brokers, underwriters' fees, printing stock certificates, those are not organizational costs.
Where do those go then?
They're generally treated as reductions to the capital raised, basically reducing the net proceeds from the stock issuance in the equity section of the balance sheet. They don't create a deduction. Also, costs incurred in transferring assets to the corporation usually aren't organizational costs either.
So the IRS draws a clear line, forming the entity versus funding it or contributing assets to it.
That's a good way to put it, yeah.
And isn't there a big difference here between GAAP rules and tax rules? I feel like I remember this from study.
Yes, very important point, often tested for tax professionals. Under GAAP, for financial statement purposes, organizational and startup costs are generally just expensed immediately.
Expense right away. Why?
The thinking under GAAP is often that these initial costs don't necessarily provide a clear future economic benefit that you can capitalize and amortize, so they're expensed as incurred.
But for tax.
For tax, it's that rule we just discussed.
Yeah.
The potential $5,000 immediate deduction plus the mandatory 180-month amortization for the remainder.
So a big book to tax difference.
A very common one. Your accounting team needs to track this carefully, leading to those M1 or M3 adjustments on the tax return.
Let's use that Christie Co. example again to really see the numbers.
Good idea. So Christie Co., new corporation, formed June 30th, began business July 1st of year one, December 31st year end.
Okay.
They incurred $15,000 in legal fees for the charter, $5,000 in accounting fees for setup, $3,000 in state and corporation fees, and also $10,000 in costs related to selling shares of stock.
Okay, so first step, identify the qualifying organizational expenses.
Right. That's the $15K legal, the $5 key accounting and the $3K state fees. Add those up.
$15 plus $5 plus 3 equals $23,000.
$23,000 total qualifying organizational expenses. And crucially, that $10,000 for selling stock.
Not an organizational expense, not amortizable for tax. It's a reduction in the capital stock account, right?
Exactly right. That's a classic pitfall people miss.
Okay, so they have $23,000 in organizational costs. That's well below the $50,000 phase-out threshold.
Correct. So they get to take the full initial deduction of $5,000 immediately in year one.
Great. What about the rest?
The remainder is $18,000. $23,000 total minus the $5,000 deduction.
Okay.
That $18,000 gets amortized over 180 months.
$18,000 divided by 180 months. That's $100 per month.
Yeah, $100 per month. Now, when did they begin business?
July 1st. And they have a December 31st year end.
So they get amortization for July, August, September, October, November, December. That's 6 months in year one.
6 months times $100 a month is $600.
Right. So you add that $600 amortization to the initial $5,000 deduction.
Christy Co's total deduction for organizational costs in year one is $5,600.
Perfect.
Yeah.
That details calculation really shows how applying those specific rules leads to tangible tax savings right from the start. Emphasizes why correctly categorizing those initial expenses is so important.
Definitely. Okay, beyond organizational costs, corporations also deal with amortization, depreciation, and depletion for other assets. What about intangibles like goodwill?
Right. When it comes to purchased goodwill, and also other specific intangibles like covenants not to compete, franchises, trademarks, trade names, these types of assets that are often acquired as part of buying a whole business. They must be amortized for tax purposes, and it's on a straight line basis over a 15-year period.
15 years again, like organizational costs.
Yep, 15 years or 180 months. And that amortization starts with the month you acquired the intangible, provides a consistent, predictable deduction over time, recognizing that gradual consumption of the asset's value.
And is there another GAAP versus tax difference here with goodwill?
Yes, another key one pops up with purchased goodwill. For tax, as we just said, it's that mandatory straight-line amortization over 15 years.
Okay.
But for GAAP, for financial reporting, goodwill is not amortized at all.
Really? What happens then?
Instead, it's subject to annual impairment testing. This means for your financial statements, you only reduce the carrying value of goodwill if its actual value is deemed to have declined below what you have it recorded at.
So for tax, you get a consistent deduction every year for 15 years, regardless of value changes.
Correct.
But for GAAP, you only take a hit if the value goes down.
Exactly. It's a significant difference. Needs careful tracking for both financial reporting and tax returns. Creates another regular book-to-tax difference you have to reconcile.
And for other depreciation, like on machinery or buildings, and depletion for natural resources.
For those, corporations generally follow the same rules as other businesses. So things like the Modified Accelerated Cost Recovery System or MECRS for tangible property depreciation, the rules are mostly consistent across entity types there.
Okay. What about life insurance premiums? Can the corporation deduct the cost of paying for those key person policies we talked about earlier?
Good question. It depends entirely on who the beneficiary is.
Okay.
If the corporation itself is named as the beneficiary on a policy covering a key employee,
The standard key person policy scenario.
right, then the premiums paid by the corporation are not deductible.
Why not?
It aligns directly with the fact that the proceeds, if received by the corporation upon the employee's death, can be tax-free, subject to those COLI rules we mentioned.
The consistency principle again. Can't deduct the expense if the income is excluded.
Exactly. The IRS logic is straightforward, prevents a double tax benefit.
But what if the employee names the beneficiary? Like in a group plan?
That's the important distinction. If the insured employee names the beneficiary and the employee essentially owns the policy or receives it as a fringe benefit, maybe as part of a group term life insurance plan offered by the company, then those premiums are deductible by the corporation. They're treated as an employee benefit, a form of compensation.
Okay, so that's a valuable way to provide benefits to your employees and get a deduction for the company.
Absolutely. Makes it a win-win for attracting and retaining talent. The company gets the deduction, the employee gets the coverage.
Got it. A couple of smaller but maybe frequently encountered deductions. Business gifts.
Right. Keep this one simple. Business gifts are deductible up to a maximum of $25 per recipient per year.
$25. Not a huge amount, but good to know for client appreciation gifts and such.
Exactly. Keep track, but the limit is low.
And business meals? I know this changed a few times. Where are we now?
Business meals remain 50% deductible to the corporation.
50%. Okay.
This includes employee travel meals, meals provided perhaps as a de minimis fringe benefit, like coffee and donuts in the office, or meals provided for the convenience of the employer on site.
So it's not the temporary 100% deduction we saw for a little while during the pandemic for restaurant meals.
No, that expired. We're back to the standard 50% limit for most business meals now. Still a valuable deduction to track accurately, but only half the cost is deductible.
Okay. Now let's pivot. We've talked a lot about what is deductible. Let's talk about some crucial non-deductible expenses.
Yes, these are the ones that can really trip you up. Lead to costly mistakes if you're not aware, because they represent cash going out the door that offers zero tax benefit.
First and foremost, what about client entertainment? Golf outings, ball games.
Zero. Business entertainment expenses are not deductible at all.
Not even 50% like meals.
Nope. 0%. This was a significant change from previous tax laws, and it's still a common area of confusion. Client golf, sporting events, concerts, theater tickets, none of that cost is deductible anymore, even if there's a clear business purpose.
Wow. Okay, good to remember. What else is firmly non-deductible?
Penalties and illegal activities. That's a big category.
Like what?
Bribes, kickbacks, naturally, fines, penalties paid to a government for violating any law, and any other payment that's illegal under federal law or under a generally enforced state law dealing with bribery or kickbacks. The IRS is definitely not going to subsidize illegal activities through deductions.
Makes sense. What about antitrust violations?
Similarly, if you're convicted of a criminal antitrust violation and you have to pay treble damages.
Right, 3 times the actual damages.
The top 2/3 of that treble damage payment are also not deductible. Reinforces the government's stance against anti-competitive behavior.
Okay. What about settlements for things like harassment?
Ah, yes. There's a very specific rule here regarding payments related to sexual harassment or sexual abuse.
Okay.
Any settlement, any payment, or any related attorney fees associated with such a claim are not deductible if that settlement or payment is subject to a non-disclosure agreement. NDA.
The NDA is the key. So if there's an NDA, no deduction for the settlement or related fees.
Correct. It's an important and specific provision essentially designed to disincentivize the use of NDAs in these situations by removing the tax benefit for the payer.
Interesting. Okay, what about taxes themselves? Can a corporation deduct the taxes it pays?
Some, yes. State and local taxes like state income tax, real estate taxes on business property, personal property taxes, and also federal payroll taxes incurred for business purposes. Those are generally deductible.
Okay, state, local, payroll taxes are deductible.
They're considered ordinary and necessary business expenses. However, federal income taxes are not deductible.
Never deductible.
Never. That's a fundamental principle of our tax system. You don't get to deduct the tax you pay on your income as a way to reduce that very income.
Right, that would be circular.
Yeah.
What about foreign income taxes?
Foreign income taxes are treated differently. You generally have a choice. You can either deduct them or you can claim them as a foreign tax credit.
A credit. How's that different?
A credit is often much more valuable than a deduction. A deduction reduces your taxable income, saving you tax at your marginal rate. A credit, however, directly reduces your tax liability dollar for dollar.
So $1 of credit saves $1 of tax. Much better.
Usually, yeah. So most corporations will choose the credit if possible.
Okay. What about lobbying or political spending?
Also off limits for deductions. Any expenses incurred in attempts to influence legislation, whether it's local, state, or federal, are not deductible.
So paying lobbyists, related travel, research for lobbying, none of that.
None of it. And of course, direct political contributions to candidates or parties are also not deductible. The IRS wants to keep a clear separation between deductible business operations and non-deductible political activities.
Got it. Finally, in this non-deductible section, let's talk about capital losses again. You mentioned earlier they're treated differently for core versus individuals.
Yes, a major difference and a common misconception. Unlike individuals who can deduct up to $3,000 of net capital losses against their ordinary income each year.
Right, that $3,000 limit for individuals.
Corporations cannot do that. They cannot directly deduct any net capital losses against their ordinary business income.
Zero deduction against ordinary income.
Zero. That's a strict rule. Corporations can only use capital losses to offset capital gains.
Only gains. So if you have a net capital loss in a given year, more capital losses than capital gains, and no capital gains to offset it against.
That net loss cannot be used to reduce your regular business income for that year. It doesn't lower your tax bill based on operating profits.
But you don't just lose the loss entirely, do you? Isn't there a carryover?
Correct. There's still a mechanism to get value from those losses eventually. Excess net capital losses can be carried back 3 years.
Carried back. To get refunds.
Potentially, yes. You can carry it back 3 years to offset capital gains in those prior years and possibly get a refund of taxes paid then.
Okay, 3 years back.
And then carried forward for 5 years.
5 years forward.
Right, to offset capital gains in future years. So while you can't offset ordinary income in the current year, you can use these losses strategically over an 8-year window, 3 back, 5 forward, against capital gains. It's a critical planning opportunity.
That carry back and carry forward rule is definitely a lifeline then for managing those capital losses over time. Okay, let's shift gears slightly to inventory evaluation methods.
Right. This can significantly impact your cost of goods sold, COGS, and by extension, your taxable income.
So how do you choose a method? Does tax follow the books?
In general, yes. The tax method used for accounting for inventory can usually also be used for income tax purposes, provided it clearly reflects income and is applied consistently from year to year. Consistency is key.
And does that $29 million threshold pop up again here?
It certainly does. Remember we said C Corp generally need to use accrual accounting if they're over that threshold? Well, specifically related to inventory, all taxpayers who have inventory are generally required to use the accrual basis of accounting for their purchases and sales, unless their average annual gross receipts are $29 million or less during the 3 preceding years.
So for many C Corps, especially larger ones, accrual accounting for inventory is pretty much mandatory.
It is. Ensures a consistent and generally a more accurate method of tracking inventory costs and matching them to revenue.
Okay, what are some of the basic valuation methods allowed?
Well, there's the cost method. Pretty straightforward, values inventories at their actual cost.
What does that include?
It has to include direct labor, direct materials, and attributable indirect costs, basically. All production costs must be included in the inventory cost.
So you can't just use prime costs or direct costs.
No, importantly, methods like prime cost, which only includes direct materials and direct labor but excludes factory overhead, or direct cost, which only includes variable overhead, those are not allowed for tax purposes. You need full absorption costing.
Okay, what else?
Another common method is lower of cost or market, or LCM.
Lower of cost or market. How does that work?
You value each item in your inventory at the lesser of its original historical cost or its current market replacement cost, usually the current bid price. This lets you recognize a loss, essentially get a deduction for declines in the value of your inventory before you even sell it.
Okay, so you can write down inventory that's lost value.
Right. There are also some other methods like rolling average with limited use, and the retail method, often used by, well, retailers.
And then within those methods, you have assumptions about which goods were sold, right?
Yeah.
Cost flow assumptions.
Exactly. The common identification methods. The big two are FIFO and LIFO.
FIFO, first in, first out.
Right. Assumes the first goods purchased or produced are the first ones sold. This is the most commonly used method, partly because it's simpler. It generally results in a lower COGS and thus higher taxable income during periods of rising prices or inflation.
Okay. And LIFO.
LIFO, last in, first out. This method assumes the last goods purchased or produced are the first ones sold.
Opposite of FIFO.
Exactly. Now, if you elect to use LIFO for tax, there's a catch. You must also use LIFO for your financial statement purposes. This is called the LIFO conformity rule.
Tax has to match books for LIFO.
Yes, and LIFO can significantly impact inventory valuations and taxable income. During periods of inflation, it generally results in a higher COGS and therefore lower taxable income compared to FIFO. That's why it can be popular for some businesses looking to defer taxes, though it can also be more complex to administer.
Okay, FIFO and LIFO.
Yeah.
Big choices there. Now, you mentioned indirect costs needing to be included in inventory costs. Is there a specific rule about that?
Yes, a very important one, especially for manufacturers and larger resellers. The Uniform Capitalization Rules, or UNICAP.
UNICAP. Sounds official.
It is. It's detailed in IRC Section 263A. This rule requires certain indirect costs that you might normally just expense for book purposes, things like certain general and administrative expenses related to production, storage costs, purchasing costs, to be capitalized as part of the cost of inventory for tax purposes. Instead of deducting them immediately, you recover them through COGS when the inventory is sold.
So it delays the deduction for those costs?
Essentially, yes. It often leads to higher inventory values and lower COGS for tax compared to books, resulting in those M1 or M3 adjustments we talked about. It's matching more costs to the inventory they relate to.
That sounds complex. Does it apply to everyone?
Not everyone. Here's some more good news for smaller businesses. Guess what?
Let me guess. The $29 million exception.
You got it. That same $29 million average annual gross receipts threshold applies again. Taxpayers at or below that threshold, using the 2023 number averaged over 3 prior years, are not subject to the UNICAP rules.
So they can just expense those indirect costs.
Yes, they can generally treat those costs as non-inventory costs, like supplies, and deduct them as incurred. It significantly simplifies their accounting and tax reporting, avoiding the complexities of UNICAP calculations. Another huge break for smaller businesses.
Definitely. Okay, one last thing on inventory. What if some goods become unsaleable or unusable, like damaged or obsolete items?
Good question. You don't have to keep valuing them at full cost if they're truly worthless or near worthless. For tax purposes, these unsaleable or unusable goods must be valued at their expected selling price within 30 days, less any cost to dispose of them.
So basically their net realizable value, what you can actually get for them.
Pretty much, yeah. It's often called their bona fide selling price. This ensures you're not stuck carrying inventory at an inflated value for tax purposes if those goods have genuinely lost their value due to damage, obsolescence, style changes, etc. You get to recognize that loss by writing them down.
Okay, that makes sense. Now let's move to one of the, I think, most powerful tax-saving mechanisms, specifically for C corporations.
Ah, yes.
And one that's often misunderstood, the dividends received deduction, or DRD.
Absolutely. A cornerstone of corporate tax planning, specifically designed to prevent what's often called triple taxation.
Okay, let's break that down. What is triple taxation and why does the DRD exist to stop it?
Right. Think about the layers. Corporate income gets taxed once at the C Corp level, right? When the corporation earns profits.
Yep, corporate income tax.
Yeah.
Layer 1.
Then, when that corporation distributes some of its after-tax profits as dividends to its shareholders, those dividends are generally taxed again in the hands of the shareholders.
Right, individual income tax on dividends.
Right.
Layer 2.
Now, the problem arises when the shareholder receiving that dividend is another corporation.
Ah, okay. Corp A pays tax, pays a dividend to Corp B.
Exactly. Without the DRD, that dividend income received by Corp B would then be taxed again at Corp B's corporate tax rate.
Layer 3.
Layer 3. The same dollar of original profit getting taxed 3 times as it moves through the corporate chain. The DRD aims to mitigate this, preventing that same income from being excessively taxed simply because it passed between corporations.
Okay, so how does the DRD actually work? How much can you deduct?
It works based on ownership percentage. Domestic corporations get a deduction based on the qualified dividend income they receive from other domestic corporations. The amount of the deduction depends directly on how much stock the receiving corporation owns in the paying corporation.
So there are different tiers.
Yes, 3 main tiers of ownership with corresponding deduction percentages. It reflects the degree of control and economic integration between the two companies.
Okay, what are the tiers?
If you own 0% up to less than 20% of the stock of the dividend-paying corporation.
Like a small portfolio investment.
Right. You get a 50% DRD. Half the dividend is excluded from your taxable income.
50%. Okay, next tier.
If your ownership is 20% or more, but less than 80%.
A significant minority stake.
Exactly. You qualify for a 65% DRD.
65%.
Better. And finally, if your ownership is 80% or more.
Like a parent-subsidiary relationship.
Precisely. You generally qualify for a full 100% DRD.
100%. So the dividend is completely tax-free between those highly related companies.
Essentially, yes. The higher the ownership, the greater the DRD percentage, mitigating more of that potential triple tax.
Is there anything else required to qualify besides the ownership? Like, do you have to hold the stock for a certain time?
Yes, there is a holding period requirement. Good point. The corporate shareholder must own the investee stock for at least 46 days.
46 days?
During a specific 91-day period. That 91-day window begins 45 days before the stock goes ex-dividend.
The ex-dividend date being the cutoff date for receiving the next dividend.
Right, so you have to hold it for a reasonable period around the time the dividend right is established. This rule is there specifically to prevent short-term arbitrage.
Like buying the stock just before the dividend. getting the DRD and selling it right after.
Exactly. It prevents companies from just quickly buying stock, collecting the tax-advantaged dividend, and immediately selling. It ensures you're a somewhat legitimate investor, not just playing a quick tax game.
Okay, makes sense. Now, you mentioned this is often misunderstood. Is there a calculation limit or something that trips people up?
Yes, this is crucial and a common area for planning and mistakes. The DRD taxable income limitation.
Okay, the limitation, what is it?
The DRD you can actually take in a year is generally the lesser of two amounts.
Lesser of.
Amount one, the calculated DRD percentage, so 50% or 65%, times the actual dividends received, your tentative DRD.
Okay, the basic DRD amount.
Amount two, the same percentage, 50% or 65%, times your corporation's taxable income, but calculated without regard to the DRD itself. Without regard to any net operating loss, NOL carry forward deduction,
Right.
and without regard to any capital loss carryback.
Wow, okay. So it's the lesser of the DRD on the dividend itself or the DRD percentage applied to a modified taxable income figure.
Exactly. It sounds complex, but it's essentially saying your DRD generally can't reduce your taxable income below a certain point. It can't create or increase a loss unless...
There's the loophole.
Unless what?
Unless you trigger a specific and really powerful exception. The net operating loss, NOL, exception.
Okay, the NOL exception to the limitation.
Right. This taxable income limitation we just described does not apply if taking the full dividends received deduction, amount one, the tentative DRD, actually results in or increases a net operating loss for the corporation for that year.
Whoa, so if taking the full DRD pushes you into the red, you get the full DRD anyway.
Yes, that's the critical planning point. Sometimes allowing your full DRD to push you into an NOL can actually be a much better strategic move than limiting the deduction just to stay slightly profitable on paper.
Why is that better? Because that NOL you create can then be carried forward indefinitely to offset income in future, more profitable years, the limitation is essentially waived if it gets you to an NOL. It's a key safety net and a really powerful planning lever.
Okay, this definitely needs an example. Let's use that Duffy Court one from the sources. It seemed to show this perfectly.
Great idea. Duffy Court owns 30% of Fox Court stock.
30% ownership means they qualify for the 65% DRD tier.
Correct. 65% of DRD applies. We'll look at three scenarios to show how this limitation and the NOL exception work. It really highlights why this is a game changer.
Okay, scenario one. Lay out the numbers.
Scenario one, Duffy Corp has operating revenue of $250, dividend income from Fox of $100, and total other deductions of $200.
Okay, so first calculate taxable income before the DRD.
Right. $250 revenue plus $100 dividend income, $200 other deductions equal $150. TI before DRD is $150.
Now, what's the tentative DRD?
It's 65% of the $100 dividend income. So $65, that's amount one.
Okay, $65, tentative DRD. Now, calculate the limitation amount, amount two.
The limitation is 65% of that TI before DRD, $150. So 65% of $150, $97.50.
Okay, so the DRD is the lesser of $65 tentative or $97.50 limitation.
Right. The lesser amount is $65. So they take the full $65 DRD.
And their final taxable income
Is $150 TI before DRD minus the $65 DRD equals $85.
Okay, scenario one is straightforward. Full DRD allowed because it was below the limitation amount.
Exactly. Now, scenario two presents a different picture. Operating revenue, $250, dividend income, $100, but now higher total other deductions of $260.
Okay, so TI before DRD is $250 plus $160 is still $65.
Okay. Now the limitation calculation.
The limitation is 65% of that TI before DRD, $90. 65% of $90 equals $58.50.
Oh. So now the limitation, $58, is less than the tentative DRD, $65.
Precisely. So we have to ask, does taking the full $65 tentative DRD create an NOL?
Well, TI before DRD is $90. $90 minus the full $65 DRD would be $25. That's still positive income, not an NOL. Right. Since taking the full $65 DRD would not create an NOL, the limitation does apply. The DRD taken is limited to the lesser amount, which is $58.50.
So they only get a $58.50 DRD, and their final taxable income
is $90 TI before DRD minus the $58.50 limited DRD, bill $31.50.
Okay, so here the limitation bit them, and they lost part of their potential DRD because it didn't create an NOL.
Exactly. Now, scenario three. This is where the NOL exception shines. Same operating revenue, $250, same dividend income, $100, but now even higher total other deductions of $290.
Okay, so TI before DRD is $250 plus $290, $60. Only $60.
Right. TI before DRD is $60. The tentative DRD is still $65, 65% of $100.
Their income before DRD is $60, and they subtract the full $65 DRD. $60 minus $65 equals negative $5.
It creates a net operating loss of $5 NOL.
Bingo. Because taking the full $65 DRD results in a net operating loss, the taxable income limitation, which would have been 65% of $60 or only $39, does not apply. It's completely disregarded. Wow. So they get to take the full $65 DRD.
Yes. The powerful NOL exception allows them to deduct the full $65, even though it exceeds 65% of their pre-DRD income.
So their final taxable income is $60 minus the full $65 DRD, which is an equal $5. An NOL of $5.
Exactly. This is a huge strategic advantage. It saved them from being limited to a $39 deduction under the normal limit, and instead allowed the full $65, generating an NOL they can carry forward to reduce future taxes.
That detailed walkthrough really drives it home.
Yeah.
Understanding that NOL exception can dramatically change your tax outcome. It's not just a minor detail, it's a major planning tool.
It absolutely is. It can make the difference between paying tax and generating a future tax benefit in these marginal situations.
So who isn't eligible for this powerful DRD? You mentioned it's not for everyone.
Right. Not all entities can claim it. The dividends received deduction is generally not available to personal service corporations, PSCs.
Like doctors or lawyers in corporate practices sometimes.
Right. Also not for personal holding companies, PHCs, which have specific ownership and income tests related to passive income. And importantly, not for S corporations.
S-Corp flow through, so it makes sense they wouldn't need it.
Exactly. You can kind of think of it as don't take it personally. PSCs, PHCs, those often have closer ties to individuals.
Okay. Any other entity types excluded?
Yes. It also generally doesn't apply to dividends received from certain specific types of entities. Things like banks and savings institutions, which have their own rules, regulated investment companies, RACs, like mutual funds, real estate investment trusts, REITs, certain public utilities, tax-exempt corporations, farmers' cooperatives, or DISCs, domestic international sales corporations.
So dividends from those specific payers generally don't qualify for the DRD for the receiving corporation.
Generally, no. The reason often relates back to the special tax treatment those specific paying entities receive themselves. Congress didn't want double benefits flowing through.
Okay. But on the flip side, we mentioned that 100% DRD, that's the maximum benefit, right? When does that apply?
Yes, the 100% DRD is designed to essentially eliminate taxation on intercompany dividends for truly integrated corporate groups.
Like parent subsidiary groups.
Exactly. It applies primarily to dividends received from affiliated corporations. Generally, if corporations have 80% or more common ownership, looking at both voting power and value, and they elect to file consolidated tax returns, then dividends paid between members of that consolidated group qualify for a 100% DRD.
So no tax at all on dividends moving within that tightly controlled group.
Correct. It's a huge incentive for large corporate structures to consolidate their operations and reporting for tax purposes. Makes moving cash around via dividends much more tax efficient within the group.
Is there any other way to get the 100% DRD?
Yes, there's one other notable situation. A 100% deduction is also allowed for dividends received by a small business investment company, or SBI.
SBIC. What are those again?
They are privately owned and managed investment firms, licensed by the Small Business Administration, SBA. They use their own capital plus funds borrowed with an SBA guarantee to make equity and debt investments in small businesses.
Okay. So the 100% DRD encourages them to invest in small businesses via equity.
Exactly. It helps channel capital where it's needed most for small business growth by making the dividend returns on those investments more tax efficient for the SBIC itself.
Got it. Okay, finally, let's quickly touch on net operating losses, or NOLs themselves.
Right. Your corporate lifeline when business takes a downturn represents a tax loss that can be used to offset income in other years.
And the rules for NOLs have changed quite a bit over the years, haven't they?
They have, so it's really important to know the current rules and how they differ from past ones, as it impacts how you can actually utilize these losses.
Okay, what are the current rules, say, for tax years 2021 and beyond?
For NOLs arising in tax years starting in 2021 and later, the current rule is there is no carryback period allowed.
No carryback at all.
None. This means you can't use a loss from, say, 2023 to go back and amend your 2021 or 2022 return to get an immediate refund for taxes paid in those prior profitable years.
Okay, no immediate refunds from carrybacks. What about carry forwards?
That's the good news. They can be carried forward indefinitely.
Indefinitely. Wow, no time limit.
No time limit going
Right.
forward, which is a significant benefit, right? Allows you to use losses from a down year to offset profits potentially far into the future whenever the company becomes profitable again.
That's great. Is there any limit on how much NOL you can use in a future year?
Yes, there is also a limitation on the utilization. The NOL deduction you can take in any given carry-forward year is limited to 80% of your taxable income for that year, calculated before the NOL deduction itself.
80% limit. So you can't use NOLs to wipe out your entire taxable income in a good year.
Generally, no. You can only offset up to 80% of it with NOL carry-forwards. This means even if you have huge NOLs available, you'll likely still owe some tax on at least 20% of your taxable income in a profitable year. It ensures companies pay some minimum level of tax when they are profitable.
Okay, so for 2021 plus NOLs,
Yeah.
no carryback, indefinite carry forward, but limited to 80% of taxable income in the carry forward year.
That's the current state of play.
And just for context, how did it work before? Like for 2018, 2020 NOLs?
Right. If you're looking at slightly older financials or tax returns, the rules were different due to the CARES Act temporarily changing things. For NOLs arising in tax years 2018, 2019, and 2020, there was a 5-year carryback period allowed.
5 years back then.
And also an indefinite carry forward. And the 80% limitation was temporarily suspended too.
Okay, so more generous rules for those specific years.
Yes. And for even older NOLs from tax years before 2018, the general rule was typically a 2-year carryback and a 20-year carry forward. No indefinite carry forward then.
Wow, okay. So the rules have definitely evolved. Understanding which rules apply to which year's NOL is key.
Absolutely. It helps interpret older financial statements and understand prior tax positions. But for current planning, it's that no carryback, indefinite carry forward 80% limit rule that's essential for NOLs generated now.
Got it. It means your tax savings from a current NOL will generally come in future years by reducing future tax bills, not by getting quick refunds from amending prior returns, unless it's one of those 2018-2020 NOLs.
Exactly. It shifts the focus from immediate refunds to long-term tax reduction planning.
Well, we have certainly navigated a complex landscape today, C corporation taxation. We've uncovered crucial definitions of gross income, explored the real power behind a vast array of deductions, and dissected these strategic advantages like the dividends received deduction and NOLs.
We really covered a lot of ground.
And understanding these rules, it isn't just about checking the compliance boxes. It's really about empowering your business to optimize its tax position.
Yeah, retain more capital, fuel future growth. That's the end game.
This knowledge really aims to give your C corporation every possible advantage, doesn't it?
It really does. From recognizing income strategically, knowing when cash in hand is taxed, to leveraging every single available deduction we talked about, and understanding those nuances of how corporate earnings are taxed, how they're distributed, the DRD. These are all vital components of a truly robust financial strategy.
Every rule, whether it seems like a limitation or a deduction.
It presents an opportunity for shrewd financial management, for smart planning.
So as you, our listener, look at your own company's financial picture, the question to ask yourself is, are you fully leveraging every available deduction?
Are you optimizing every nuance of income recognition? Understanding when that upfront cash becomes immediately taxable?
Are you capitalizing on every strategic exclusion, every special rule like the DRD or the exceptions for smaller businesses to truly maximize your C corporation's financial potential?
Because the details we've discussed today, they aren't just rules buried in the tax code, they are opportunities. Opportunities waiting to be seized.
Opportunities to put more cash back where it belongs. In your business, driving your growth.